G'day folks, today we're going to have a quick look at divergence. I'm going to build it up over the next couple of weeks, so today will just be very basic divergence, and then we'll look at a more advanced, more complicated divergence next week. So what does divergence mean? It of course means difference or points diverging from each other, moving away, where convergence would mean things coming together, things converting, coming together at the same time. So divergence, of course, is the opposite of that. Things moving away from each other or differentiating. So when we have the market making highs like this, like we can see there, and we might have a MACD indicator or a oscillator indicator, we're going to be focusing on the MACD and we're going to be focusing on the stochastic with standard settings. So when we notice that the price, the 2 points are diverging from each other. So in this instance, we actually have the market making higher highs. But on the stochastic and or the MACD, the market's making lower highs. We call that diverging. So in other words, this point and that point, okay, is diverging if you compare it to what's happening on the oscillator indicator. So once we notice this, and we will obviously focus on more on price action as well, if this top is a good area to sell based upon a trend of a higher time frame. So when you spot this on, let's say, the 1 hour chart, and you need to just establish if it's with a trend, either with a 4 hour or the daily, or even as high as the weekly if you like. If you can spot that it is with a trend, so the ABC is there. So for instance, if this was a sell setup on the 4 hour chart, we might have this type of a setup. Or the daily chart, we might have this type of setup. So that's our A there, that's our B, and of course our potential trading spot over there. Now on the 1 hour chart, price maybe have trended up to get to that area. Okay, that's when we will try and look for a setup like this on our 1 hour chart. So simply, how do we enter the price? When we clearly see the diverging points, we look at in between the two diverging points, a cozy little low point, and we use that as a breakout point. So just below that low point, we put out a pending sell order to short it. A buy would look like this. The market would make lower lows, but the oscillator indicators is making lower highs. Okay, now those 2 points, okay, compare with each other. Let me just redraw that on top of each other. The market's made lower lows. The oscillator indicator has made a higher low. So once again, you compare that with each other, and they're going in the opposite direction. These 2 points compared to the oscillator 2 points is going in a different direction. So once you spot this, once again, this on a 1 hour chart, for instance, would be against the trend. As long as it's with trend on a 4 hour chart or a daily chart. So a clear higher high, a clear higher high, higher low, okay, clear area of support or resistance. Now you want to long it. Now you see the divergence build up. You pick a cozy point in between the two low points, a nice cozy high point, one that makes sense for you, and that's where you put your pending buy order. So that will be a pending buy order. Okay. We also, of course, have hidden divergence. I'm not going to get into that today. It's complicated. I will get into it later, but it's not that important. The most important, the basic what we're talking about today is the most important. Being able to spot these 2 diverging points. Sometimes they're nice and close to each other like this, which is the ideal for our breakouts. Sometimes they might be a bit further away from each other. So they made a point, went far away, and then made another point. So there's a big price action in between the two. Okay. So those can be important as well. Okay, but my favorite 2 is where the 2 points, the diverging points, are close to each other, and there's a little cozy low in between the 2. So let's just have a look at the market. The Euro USD is what I'm looking at, and this is one of these examples of where price is the 2 points are quite far spread out, where there's been lots of price action in between the 2 diverging points. So this point and that point is diverging with each other. So you must pick a cozy low point in between the 2. The extreme low, of course, is this one here. Now that's a bit too far away. So you want to pick a more closer low. So exactly what's happened here Price took this out, so you could be in a short right now. Okay, it is retracing right now. Hopefully, if you did sell, it will still go down. We're not in yet. This is not the ideal setup for me. Those who've been following the newsletter and been on the chat room will also know this is kind of a wedge, a triangle over there. Okay, a rising triangle. So we are expecting it to break down. This is it's broken to the bottom here, and it might still break down. It might still give candle info to go down here. If you're not in already, what you can use as a trigger is a takeout of that low to more or less trade down to this area or that area there. Okay, so this is the biggest structure of a triangle, but in the triangle we do have bearish divergence, which is from that point to there, from that point to there. Now this is the type of divergence that we like, where the 2 points are relatively close to each other. There's just a little cozy little low point in between the two. Price takes that low out, and like you can see here, it went down a bit. It didn't go down miles in this case, but it went down a bit. 32 pips. You could always put your stop above the most recent high. Here's a nice example of a bullish one where the market went quite a bit. So these 2 points are diverging with each other if we look at the stochastic and the MACD in this case. So in between these 2 points we pick a cozy high, and that one over there makes sense. Price takes it out and it goes up quite a bit. Over here also that cozy setup, totally with trend as well. A, B, C, lower low, lower high over here. Price retraces to a Fibonacci level as well, 61.8. This is like perfect setup. Market makes these two little diverging points with each other. You can see it nice and clearly on the stochastic. A little cozy low in between those 2 points, and the market takes it out. Okay. This is also a nice one. I like this one as well. Price set up the diverging points. We could not see it so clearly on the stochastic, but we can see it on the MACD. So either or, if you can see it on both, even better. And of course, as we can see, the breakdown point got taken out. Now the breakdown point is quite important. As you can see here, here's a one that didn't work, but the breakout point was never taken out. Where is it over here? Sorry, over there. Those 2 points there. This one of course did work. I was just trying to get that one closer. So these 2 points, the cozy point in between that is there, and of course price never took it out. Never took it out, so you never would have entered that trade over there. This was not a diverging point. The MACD as well as the stochastic did not set up divergence. Here we have one. Here we have definitely 3 diverging points that were just kept on diverging. Okay, so initially you could have used that as a breakout point, although it was quite far down. I don't like it if it's so far down. But then after making another diverging point, which you will call extreme divergence, the fact that all those tops are so extremely, they at the happening all at the same level, so that makes it a what we call extreme divergence. And you can see it just on the MACD, it just kept on going down. So now you could have picked yourself a tighter, a closer breakout point, which of course would have been a much better idea. You would have taken the trade, you would have made 40 odd pips. Down here we have another bullish one where you could see from these 2 points down there, price is diverging up, but the points are still going lower. And once again, just a little cozy point in between the two, which you can see is that point over there. Okay, price took that point out, and it absolutely flew up. Okay, very, very nice little setup. Over here, once again, we have the 2 diverging points with each other. Okay, if you look nicely on the stochastic, you'll be able to see it going down there. Also, the histogram bars of the MACD is definitely pointing down, with volume running down. So you pick a nice little breakout point in between the 2 highs, and bang, she takes it out, and bang, she goes down. Okay, obviously she takes a while. She takes a while to pay. Okay, that's where patience comes in. Here again we had diverging tops, but the market never took the low point out, so you never got a trigger into that one. Okay, that was the 2 low in between the diverging points. Okay. And the market is full of examples like this. Here also is the type I don't like, where there's lots of price action in between the two diverging points. Okay, all the way from here going down there. Okay, not my favorite. But in this case it worked. This is more my favorite, where we definitely have two close diverging points with a little cozy one in the middle, and that one went quite a bit as well. I mean, that one went at least 37 pips. Okay, which is good profit for an intraday trade. Okay. So now I'm going to take it just one step further, and I'm going to just add some Bollinger Bands in here. Okay, I'm just going to add some Bollinger Bands, which can help Bollinger Bands with this. Insert indicators. Okay, for those of you who've been attending mentoring often would know how Bollinger Band works. Okay, you've got 3 lines. Just removing all these guys quickly, just these oaks. Let me just leave that. Okay, so when price touches the outer bands, it is oversold. Okay, overbought. In this instance, it's overbought. Over here, when price touches this outer Bollinger Band at the bottom, it's oversold. So when it touches the top one, it's oversold. When it touches the bottom one, it's overbought. In between is the mean. When price is trending very strongly, it will be bouncing off the mean. Okay, but when it's exhausted, it bounces off the overbought or the oversold area. So when we do this divergence, it's best that price has hit the overbought area or the oversold area. So in this case, the oversold area would be where you would look for bullish divergence. Okay, so here in this instance, we did have the extreme divergence. Okay, if we look at the stochastic going up, it's going up over here where those points are totally equal. So there we had extreme divergence. And of course, you pick yourself a breakout point and price goes up. Okay. Always best to stick with a trend, so a bigger time frame trend, either the 4 hour or the daily if you're using the 1 hour. If you're using the 4 hour, you use the daily and weekly trends. If you're using a daily, you're using the weekly and the monthly trends. Here we had also slightly divergence as well, right here at the top after it went overbought. Okay, and then of course after it went overbought, takes out the low, bang, it goes down. Okay. Very important then when you pick a breakout point, that the breakout point is not in an overbought area or not in an oversold area. Okay, the breakout point must be in and around. Okay, so when you pick a breakout point for short, that short breakout point mustn't be touching the oversold area. Okay, if you're doing a breakout for long, like this point here, just make sure that the breakout point isn't in the overbought area. Okay, there must be lots of space from the breakout point to where the overbought area is, and in this case where the breakout point and the oversold area, there must be lots of space. Okay, so all along some of these ones that were winners, when we look back, every time it went overbought, sideways form divergence, pick the breakout point. That's nice and spacious. I mean there is space available for you to trade in the opposite direction. Okay, this one's breakout point was a bit more dodgy. Yeah, we can see this one's breakout point did touch the overbought area. That makes it a bit more risky, of course. Okay, this one here is perfect. There was space to go. If you look at this area, the breakout point, there was lots of space to go before it hit the oversold area. This one was also a bit dodgy, but the nice thing was, if you look at the Bollinger Band, look at how it squeezes and then it opens up. Okay, when it squeezes very tight like that and then starts opening up, usually the break out, the way it breaks in will be a true break, which is what happened over there. Okay, that also would have been a dodgy breakout point. Look how close it would have been to the oversold area. It would have been a dodgy breakout area. Okay, that would have been a good breakout area because it had lots of space to go to the overbought area, except it wasn't divergence in this case, of course. Here as well, dodgy breakout area. It's too close for me to the band. That would have been a very bad breakout area. Okay, in between these two done. Look how it's definitely by the oversold area, totally and utterly by the oversold area. So you should never sell there. Okay. This breakout point was pretty good. Lots of space from this point to where it's overbought. Lots of space. Okay. So guys, the basics. Overbought. Okay, overbought. You look for a higher time frame. Is there a trend on a higher time frame? Okay, now, and what do you do to check for trend? Well, the very simple, of course, looking for lower lows, lower highs, or higher highs, higher lows is of course the standard way. The very, that's always important. But also a very easy way is to put yourself a 50 moving average in a simple moving average applied to close, and you go to a higher time frame. So at this point in time, and I'm just going to make a big X there. If I go to my 4-hour chart, I could see that it was above my moving average. So it was against the trend on the moving average. But if I go to my daily chart, at that stage, it's clearly below the moving average. So yes, it's still with trend on a bigger time frame. So when you use your 1-hour chart, you use your 4-hour and your daily. Either or of those or both. If you use your 4-hour, you use your daily and your weekly. If you use your daily as your main entry point chart, you use your weekly and your monthly. So it needs to be in a trend, in line with the trend on a bigger time frame. Very important. Okay. So in line with a bigger trend, you take it once it is overbought or oversold. It clearly creates two diverging points, and it is a nice cozy little breakout area that you can focus on. Okay, that is not close to the overbought or oversold area. It must be room for you to go. If you're selling, it must be far away from the oversold area. If you're buying, it must be far away from the overbought area. Thank you very much, everyone, and we will expand on this next week. Thank you.